In the next 20 minutes, I'm going to walk you through exactly how I built a $6 million property portfolio in just 8 years as a single first-generation migrant who arrived in Australia with just $2,000 in my bank account. If you're watching this and you feel like property investing is only for people who already have money, who have family connections, who understand the system, I get it. Because 12 years ago, my wife and I couldn't even get approved for a rental property. We were rejected again and again and again. I actually had to borrow money from a friend just to show the real estate agent that we have some savings in our account. My name is Ankur Gautam. I'm the founder of Heaps Good Homes. By transacting over 300 plus properties for myself, my clients, friends, and family, I've developed frameworks to choose the best strategy and property that aligns with your goals, situation, and circumstances. In this video, I'm going to share my exact journey and the framework I've developed that guided every single purchase. I'll start by telling you about the moment everything changed. It was 2016. My wife had just lost her job, and suddenly 80% of her income was going to rent. We were living in a second rental property in Parramatta. The first one was bad. It was basically unlivable. And I remember that sitting thinking, we came to Australia for better life, but it feels harder than what we left behind. Everyone comes to that point where they think, maybe we should just go back. I looked at my colleagues. They were all focused on building property portfolios, while we were bloody poor compared to them. But I decided to channel that into motivation. I thought, I'm going to be the best amongst everyone else around me. And the only way I can be the best is by acquiring knowledge. Every single day on my 1-hour train commute, while everyone was on TikTok or Instagram, I was doing online courses, learning new technology, studying new data analytics frameworks and tools, becoming better and better at my job as a data analyst. Within 2 years, my wife and I reached close to 90% of the maximum salary possible in our professions. That marked the end of what I call the knowledge accumulation stage, building skills, increasing a value, and maximizing income. A lot of people think wealth starts with buying assets, but in reality, it begins with knowledge. You need to reach your earning potential first by becoming more valuable in your career. That strong foundation then allows you to move into the next stage, that is asset accumulation stage. For us, that began with the first property purchase, a 2-bedroom apartment in Parramatta for $650K. It was actually the same place we were renting. It was completely emotional decision because we loved it and wanted to make it a home. But I'll tell you right off the bat that it was definitely the worst decision we ever made in a journey. And that's because it was emotional, not strategic. If it had been strategic, we would have looked at the data like days on the markets, building approvals, and vacancy rates. All the signs were pointing it to be a bad investment then. Big developers had been approved to build more than 500 plus apartment units all around the area, making the supply and demand fundamentals completely wrong for successful investment. It's been 8 years. We've seen maybe $70,000 in capital growth. The good thing about a bad investment though is that you learn a lot. And this mistake is what led me to develop what I call the golden tap method, a principle-based framework that has guided every single strategic purchase after this, including my next 6 properties. My second purchase was a dual income property in Blacktown for $845K in the year 2020. It is classified as dual occupancy because it was a house with a studio above the garage. The key insight was simple: 2 income from one asset, rent out separately, maximize cash flow, and keep the risk contained. From day one, this property delivered an 8% yield, generating $1,300 per week in rental. Today, it's valued at $1.3 million. That experience gave me the confidence to double down on the strategy focused on self-sustaining and high-growth properties. After seeing how well the dual income model worked, I doubled down. This time in Perth, in the year 2021, I bought a dual key in Alkimos for maybe $590K from memory. A year later, another one in Baldivis for $570K. Now at the time, everyone thought I was crazy. Perth wasn't hot then, but I was reading the data. It was all pointing to low supply, rising population, and yields about 10%. And I decided to follow a principle that now forms part of my strategy. Money flows where people move. Both were dual key setups, so they had separate living spaces, meaning separate rental streams. Alchemos now generates $1,100 per week and is now worth $890,000, probably more by now. Boldavis does $1,000 per week and now worth $850K minimum. Together, these two properties produce over $100K a year across 4 rental streams. By this point, I had built a strong foundation of high-growth, self-sustaining properties, but also knew that cash flow and market momentum alone wouldn't get me to the next level. I wanted to introduce manufactured growth into the portfolio, something more sophisticated than just riding the market. So in the year 2023, I partnered with a close contact and entered into a joint venture. Together, we bought a house with a granny flat in Oxley Park for $1 million. Now, this purchase actually has a massive development opportunities with zoning potential for 8 townhomes. But while we wait for the right time to build, the existing house and granny flat is already making $55,000 per year in rent. That means the holding costs are largely covered. And since purchasing, we've already seen a $400K increase just from the market momentum alone and also the rezoning. And once the development is completed, the estimated uplift will be at least around $500K. After stepping into development, I wanted to maintain momentum with another high performance cash flow asset, but I also wanted something simpler to execute. That's where I discovered rooming houses, which are essentially co-living setups that generate multiple income streams from single property. In 2024, I purchased a property in Morayfield, just north of Brisbane, for $750K. Each room is furnished with a bed, TV and its own bathroom, designed for people who want quality accommodation without the hassle of setting up a full household. For me, that means I can generate $1,500 per week in rent. That's over $76,000 annually with a yield north of 10%. And because it's diversified across multiple tenants, the risk is far lower than a single family rental. So this year I decided to buy another one of these properties, this time in Marshall, just outside of Geelong in Victoria. This property is still under construction, but the setup is almost identical. Once complete, it's expected to rent around $1,400 per week, delivering a projected 10% yield. Alongside my personal portfolio, I also built a strategy in my SMSF. This one is a little different because you can't build new properties inside an SMSF. Also, you can't renovate or develop so easily, so the usual value and strategies are off the table as well. So I had to approach it differently, but it was simple. Use the SMSF to hold affordable assets that have short to medium-term growth potential and exit when the timing is right and then reinvest the boosted balance later. So I pivoted towards established home in regional Queensland. I bought one in Rockhampton for $440K and Townsville for $450K. Both were sold within 2 years for $620K and $630K respectively. That gave my SMSF a capital uplift of roughly $300K even after tax. Now we're deciding how best to use that uplift, and I'm considering a commercial property next, possibly even purchasing a co-working office for Heaps Good Homes and other businesses to lease together. That way we create a closed loop investment. That's where my portfolio is at currently. It's about $6 million, generating over $400K in gross rental income. What surprises most people about my portfolio actually is that I've never used equity to fund the purchase. Every deal came from savings and positive cash flow from previous assets. I made the choice early on to avoid refinancing because I didn't want to create hidden risk in the background. When you pull equity, you're effectively increasing your debt load. And if your strategy relies on continuing forever, you're assuming nothing will go wrong. But I've always planned for the worst case scenarios: job loss, health issues, market shifts. So I built this portfolio to be self-sustaining at every stage without needing to stretch or over leverage. Everyone's different, and I'm not saying equity is a bad thing. It's a great tool if you can access it. This is just how I have chosen to build my portfolio, and it's worked well so far. So that's the portfolio, but more importantly, let me walk you through the key lessons that came with each deal. These are the insights I wish I had known earlier, and hopefully they'll be useful as you build your own. Lesson number 1, focusing on building your earning capacity first. Before I invested in property, I spent years investing in myself, learning new skills, increasing my income, and getting my financial foundation right. Let's say if you're earning $80K and trying to scale a portfolio, the truth is that the biggest leap forward might come from increasing your income, not your asset count. That's what gives you more borrowing power, more buffers, and more freedom to make smarter moves. Your ability to earn is often the most underrated asset, and it's the one you have the most control over early on. Now, lesson number 2, self-sustaining properties beat everything else. Here's why. If your property can pay for itself regardless of interest rates, job losses, or health issues, you have true financial security. I would rather have a property with an 8% yield with 4% capital growth than one with 6% capital growth and 3% yield. That brings me to the lesson number 3, which is the framework I promised. The golden tap method. I developed this after that Parramatta disaster to make sure I never made an emotional decision again. It's built on 6 core principles. Principle number 1, money flows where people move. I only invest where the population is growing. If people are not moving there, I'm not going there. Principle number 2, buy when supply and demand is imbalanced. Markets are very inefficient in Australia. You can't have the right balance all the time, and this is what creates opportunities. Principle number 3, if locals can't afford it, I can't afford it. I would never buy in a location where local wages are too low to afford the house prices. Sometimes investors keep pushing the prices, but once they leave, the locals can't afford it. I don't want to touch it. Principle number 4, a strong local economy indicates stability. I look for diverse employment, infrastructure projects, and economic drivers. Principle number 5, stay cautious at market peaks. What seems like a summit could be the edge of a cliff. I always ask, is property growth driven by true demand or just a short-term hype? And principle number 6, your strategy shapes your path. This is the most important personal principle. What works for me might not work for you because your investment strategy defines your buying criteria. It all depends on your budget, timeline, risk appetite, whether you're aiming for yield or growth, and how hands-on you want to be. This principle is what ties it all together. The 4th lesson I learned is that principles beat data points. Everyone gets caught up in vacancy rates and days on market, but if you're looking at a suburb with only 5 rental properties, that 6% vacancy rate is statistically meaningless. Focus on principles first, because data can change within 2 months. Lesson number 5, being a migrant is an advantage because we understand what it's like to start from zero, and that forces you to think differently. You learn to respect money, you build habits around saving, you work harder, and you think long term, and not just about getting rich, but also building stability. And that mindset is what's helped me build this portfolio. Now, maybe you're not a migrant, but if you ever felt like you are starting late or starting behind, the same lessons apply. Where you began doesn't define you. What matters is how you respond to the constraint you've got. And the lesson number 6, arguably the most important one on the list. Your investment journey shouldn't be about getting rich. It should be anchored in peace of mind. For me, that became clear during the moments I had nothing to do with money. When my wife lost a job, when I had health issues, when we went from planning for 1 child to raising 3, life shifted in ways we couldn't predict, but our lifestyle didn't. We didn't have to sell assets. We didn't have to cut back. We didn't panic. And that's when I realized this isn't about building wealth. It's about building certainty. Hopefully that's enough motivation to get you started on a journey. Right now, I'm still in the accumulation phase, working towards my goal of $800K in passive income by retirement in 2045. I've mapped out exactly how I'll get there, showing when my borrowing capacity will free up, where I can acquire new assets, and how my equity position will evolve at each stage of my life. This journey is what led me to start Heaps Good Homes. After helping friends and family with their purchases, I realized there was a real gap in the market. People needed someone who had been in their shoes, who could guide them without the usual sales pressure. Since then, we've helped more than 300 families with their property decisions. We've built one of the most comprehensive networks in the industry, access to almost every land estate, 300 plus builders, and a nationwide coverage for new builds. In the established market, our proprietary systems, backed by ex-CBA data scientists, scan 1,000 plus selling agents' website, undercover off-market deals, and identify true unicorn opportunities. More importantly, we take time to understand every client's unique situation. If you would like to learn more, there's a link in the bio to get in touch.